Okay, cool. I'm just going to talk a little bit, and feel free to chime in, James, if you got anything to add, or if anybody else wants to speak, just raise your hand or whatever and request. The whole point was just talk a little bit about OPEX, nothing too specific, more like the mechanics. The positioning into May actually was a little bit exciting maybe a week ago. A lot of it was closed down yesterday. So I think that was maybe somebody's question on here too. Like, why would you, it was FT Trader, I believe, had the question. Why would you even trade AM expiration? Great question. It's not one that has a clear answer to me. I've wondered that for a long time. As the market maker, for example, we used to only have, well, I should say, I'm going to date myself a little bit here, but let's go back to like maybe 2010, 2012, 2013, et cetera. The big positions were basically the monthly OPEX, the end of month, and then they started adding Fridays, and Fridays were like our weekly contract. It's actually funny to think about now that Friday was the gamma option. And so they're basically anywhere from 4 to 5 X's in any given calendar month, and we didn't have 0 days. So AM was the only AM settled. It was still pretty much the dominant place to execute strategies or to run these option selling programs. Then they just started adding things throughout the course of the next 10 years. And they filled in the calendar, and they did it always with PM settled options. Now, the funny thing about the CBOE is it seems like it's a CBOE product, and it is, but apparently, a little bit of history, the CBOE wanted PM settled options, but something about the regulatory backdrop at the time, they were kind of compelled or just had to go along with the way things were already set up. The Merck had already listed index futures settled in the morning. And so the CBOE just had to kind of go along and match their calendar. So the AM settled options are actually not the CBOE's choice. They're kind of a function of how they had to follow the futures market. But now we have a situation where literally everything is PM except for this one third Friday serial. And ironically, I still call it the regular expiry, which I still think is hilarious. But there's been attempts to move off of it forever. It still seems to be the place where all the flow happens. For a customer, a lot of these funds, they will roll things with multiple days till expiry, or maybe there's like some kind of movement that happens that compels a rolling or a closing trade. But for the most part, they're either going to roll them or they're going to let them settle. And so what you don't get in the AM options is like the same behavior that we would be concerned about with our positions, like closing something, racing to adjust something before the settlement. You don't get a lot of that. Now, if you're new to options and you trade 0 day or SPX in general, should caution you guys to avoid trading SPX AM in your personal account if you haven't already committed to one, to one strategy or another, because you don't have the right to trade it after 4:15 p.m. Like FT, I think it was FT pointed out in the thread. Market makers or customers, no matter what you are, you can trade overnight in other contracts, but the SPX AM is completely closed at 4:15. Now that's cool for us from our perspective. For a market maker, it kind of sucks also when we didn't have so many tools available to hedge gamma or to balance positions. This used to be kind of a nightmare sometimes. You get big concentrations. I would say this is also a nightmare in the past too, when a lot of the order flow was stuck in this AM expiry before it kind of got distributed out to all the different dates. You'd be stuck with big positions on strike, and everybody was trying to close the exact same thing. Like incredible distortions. You'd have to pay so much money to get out of positions when they were concentrated. It was not even worth it. So basically, you'd take this thing into settlement, and you knew that you were kind of rolling the dice, and everybody had the same thing on. And the problem is you can't trade the options overnight. You can only hedge with futures. And so a real kind of nightmare. And then you have to hedge into the print. The print, again, I kind of refer to the SOQ. It's all the same. You'll hear it called the SOQ, the settlement, OPEX, whatever. The idea is in the morning at 9:30, the CBOE goes through this process where all the underlying stocks in the index go through their individual opening rotation and their auction process. And then those opens are reported to the CBOE. And then the CBOE calculates the index. So you almost never get the index opening settlement right away. It comes in like as a percentage, depending on how many stocks have reported. And then you get the final. The VIX is actually much more clean in how it's done because it's all done in-house at the CBOE. But so you have a cash product and you have a futures hedge as a market maker. So you're going into this and you're hedging overnight because you can't trade the options. What you can do is model them. And you are hedging your delta, your gamma, and of course your delta decay based on whatever you're modeling them to be. But you have futures that need to come off into the settlement. And so you wind up having to trade into that used to be the case, at least, if you don't close down what we call our roll position. Now it's a bit easier because the CME, God bless them, they've been good over the years. They can't really compete necessarily with CBOE's like dominance in the options market, but they've kept rolling out products that help manage the options product over the years. So there's the BTIC, for example, which has use cases besides just besides just options market making, but it's beautiful for end of day delta hedging. And they have something called the TACO too. So it's called the trade at contract open. So all these things kind of allow market makers to hedge their delta more cleanly. But what we're going into right now is this period where you're still hedging with the futures, and it's becoming more and more driven by the decay of the positions held by market makers. Uniquely, because you can't trade out of your position, what we see, assuming we have the correct inventory, is pretty static, right? So this is also unique to serial expirations. If you guys are familiar with options calendar cycles and how the quarterlies differ from the serials, next month, for example, if we have a similar call or a similar conversation, I would have to tell you guys that June, while it looks really interesting and there's really big positions, there's this kind of fungibility in the June contract between the ES and the SPX. When you normalize for the multiplier, they're basically the same thing, right? Because the June contract expires into June futures at the CME, but those June futures expire into the SPX opening SOQ next month also. So for our purposes as market makers, the quarterlies, even though they're big positions, big notional, we wind up having a little bit easier of a time sometimes settling them. Like technically, we can close our position with a fine tooth comb because, as you guys know, in the ES, it trades overnight. It's very liquid. Another feature that market you probably don't understand is for retail, you can send any spreads you want electronically into the complex order book as a customer. Can't do the same thing as a market maker. So for the SPX, when we're stuck with a position, if we want to close it, it's a combination of either like setting an algorithm to kind of like adjust quotes or regress into flow to get out of something, or it's literally just quoting and closing something. Very manual, very costly in some sense because you're either implicitly paying a bid ask, or you're actually paying costs to quote and close. In the ES, there's the complex order book, which is extremely liquid and anybody can submit to it. And so all the positions are extremely manageable, much easier to handle. Ironically, less stress, even though from the outside looking in, the volumes in those positions are huge. So 1 second. So questions. There were some good questions. Some were kind of just silly. This one about hot dogs eating yourself or Jesus microwave burritos. I'm gonna skip those for now. But let's see here.
Quad witching. Touch on it. I like quad witching. Let's do that. Let's do a depth on that one.
Why is that one so important again? Because they all expire at once. Is that the thing?
I don't know. You listen. I'm just here, listening to you like everybody else. You know more about it than I do, buddy.
I think I kind of just touched on it, right? With the idea that whatever it is, there's this convergence of all these products expiring at the same time. But in a way, yes, there's the truth that the positions are bigger. There will be more fundamental exposure coming off a lot of the times in these quarterly expirations. But the fact is, for us, it's actually a little bit easier to manage. Like I would take a June expiration over a May expiration any day because it's less stressful when you have products that are fungible like that. But we'll see. This is a big June cycle, I think. Obviously, you guys know what kind of inventory we're coming up against. This big JP Morgan collar position. And then in June, there's a lot of hedging. Usually in quarterlies, you get more hedging, both the quarterly month itself, like the third Friday, but also the end of month. And you get all the traditional flow plus the hedging. And so now we have this kind of interesting window we're coming up against. I'm not going to spell it out exactly, but VIX expiration could be very important because the mechanics that we suffer with in the SPX are also similar to what you have to deal with as an option market maker in the VIX, right? It's a little bit maybe more wonky to model, but you have very similar things going on. You have gamma and charm and delta decay and positions that will cause you to buy or sell futures, either actively or passively in a way that distorts the market's perception of what's going on. And so I think that's probably what's happening with the VIX right now. There was a good question about, somebody took an opportunity to troll me. I always welcome trolling about my view that we would see a VIX floor of 20, right? So, you can never predict exactly. But what I do think is maybe going on, and this will be borne out next week if it's on point or not, is that when we come up from these high levels in the VIX, there's so much interest in selling vol. Now, it's not really easy to just sell VIX futures, and a lot of these ETFs are junk. I shouldn't say that. I'm not going to opine on the ETFs. Options are a great place to go. VIX options are a little more difficult. They're more wide, a little less predictable, but they're, if you're doing something on a wider time frame, it's all well enough if you're not hedging it. VIX put 1x2s, put spreads. People sell where they think the floor is, or I put spreads into the floor and use that to finance something else. Like, a recent trade I saw pitch was like selling the VIX 17 puts to buy the June 61.5 call, 9.5 61.5 calls. It's all reasonable. But the put spread inventory is interesting to me. And this is why I think it's going to be increasingly important to get good visibility into what's going on across complex, because if, for example, we're coming up into an expiration where we get stuck into this charm pattern, that can be a little bit deceiving for the market, right? It could actually force vol to go lower than it might otherwise go. And then that kind of knocks in this sentiment feedback loop too. So we start out with mechanics, and then oftentimes people lag mechanics and then start ascribing meaning to what's happening systematically. By the time the systematic force has run its course, people are kind of all in at the end of that tail, with nothing underneath them supporting the move. That's kind of my concern here at this juncture right now, is that I believe that there's a good chance that we'll find out that the VIX is maybe not, it might unclench up, not down. It's not like the VIX gets squeezed up in expiration all the time, just like the SPX doesn't get squeezed up all the time. It just depends on what the exact positions are. Does that make sense?
Yes, sir. Well, VIX moved a little yesterday. I was wondering who was, adding liquidity or, leverage into the market was my joke that I posted. But that's a different side of the coin. I know.
Should be down again today. Yeah. So it's pressing, like right now the pre-market is pressing 1735, 1730. It's interesting because it aligns with a lot of the positioning in that expiration next week. Now, the funny thing is we're kind of like sitting here seesawing on what is probably like peak Vega, maybe not necessarily a really intensive like Vanna moment in the SPX, because you can see even if you look at like 3 month and 1 month skew, they've come off recent highs. That's kind of what you'd expect, at least 1 month, when you're pressing into this territory, right? Depending on the structure underneath you in the SPX. When you get to certain ranges, you guys will notice this all the time, especially if you're in the industry. You see this commentary kind of from the sales side or tourists, especially news pundits, about how like some behavior in the index or the index vol complex suggests that everybody's abandoning hedges or throwing in the towel. What really happens most of the time is we just run into a range where you're going to start to see positions change, because we model positions to drive our pricing. And so we have all these things, these novel approaches to make sure that we're not doing anything deviating from our pricing, from our inventory. Like, just check something really quick here. I don't love this index. I'm going to see if it actually validates my point right now. Really quick up. But when you look at skew, there's a number of ways to look at skew. Obviously, the CBOE has a skew index. Not my recommendation for like trying to infer anything about the market. But right now where we are, if you just fast forward a month, you're going to start to see, actually, if you just fast forward like 3 weeks, you're going to start to see the skew index naturally climb. And people will start to wonder, what does it mean? You'll probably see some art written on it. And really all it is telling you is that there's some position that's causing strain, and it's fixed in terms of strike. But because it's fixed in terms of strike, it's going to decay and get smaller and smaller and smaller in terms of delta. And when it crosses into this window that these skew indexes try to pick up on, amplify this perception of risk, which will then knock people into talking about it, and ironically make the market a little bit more shaky just because of the increased visibility of something that was always there in the first place. So a lot of fun about these indexes. Skew is one of my favorites, but this is probably a little bit on tangent right now. What about OPEX questions? Any good ones? James, can you see the actual thread itself? Because I'm blocked here. I see my own thread.
That is not. Where's tech support at the house? That's a trick. Don't answer it publicly. Hold on, I'm looking. We have just listening in. Appreciate you. We're reaching 6,000 today. Now that we 59.25 in pre-market. Thoughts on today's OPEX? Personally, I don't like to trade OPEX because of how volatile it can be. Admire this trader's ability to analyze data. Okay,
no, that's spam. Don't look at the spam.
That's spam. Yeah, don't follow. Listen, follow Vols. Don't follow those people. Trust me.
I try to hide them. If you look at my replies, sometimes you'll see I try to do you guys a service by hiding replies.
Crumb collector is around all the time. He says he can hear us.
Good.
Whatever you use SPX and VIX for the next 30 days. Oh, what's your view for SPX and VIX for the next 30 days? That's a good question. You want to give us some color, give us some free market maker awesomeness here. Help out the poor people.
Yeah, kind of like the top and bottom. I don't know.
Pick a number.
I think we're probably, there's a lot of like sentiment kind of chasing right now, but sentiment isn't always the reality of the move. A lot of the stuff that like people have based their sentiment on, like short squeezes, for example, these catalysts like systematic like CTAs and bulk control and short squeezes, you've probably already seen a lot of them knock in. And so now we're at this range where like everyone is still kind of relying on this as being indicative of the speed at which we should ascend. And so I have people in my my Bloomberg chats or my different forums who are talking about levels as high as like 6,400,000. And it's almost like you can almost see the euphoria building, but they forget that like we gapped through important levels on overnight because of headline. At the end of the day, a lot of this stuff has still created background volatility, background noise. It's impacted flow of funds cross border, hasn't been resolved yet, but it kind of gives people this false sense of security. And then the fact that we move so far, so fast, people find as like evidence that they're right. But the fact is, like, that's just mostly systematic. When it happens overnight, it happens so fast. We move through negative gamma at 57 quarter and CTA stop-ins. And so now we should slow down. We should slow down for a number of reasons. To get from here to the next leg up, like, for example, if your thesis is all-time highs, well, that's fine, but that needs actual hard delta, probably discretionary money to flow back into the US to get us there, because there's a lot of absorptive flow here. Primarily, you guys know about the JP Morgan collar. It's a very obvious one. There's concentrations around it too. And then there's also a lot of calls bought above us, which contributes to like a lowering skew and upside, maybe negative gamma if we get higher. But the flip side of that is every day that passes, those deltas bleed and kind of push us back down. And the fact is, if all these calls are struck at higher levels, well, what's the implication for the actual entities buying those, right? Those are hedges maybe for a breakout. And if they're hedging a breakout, they're probably not going to be buying the breakout in the same way. They're kind of, it's like equity replacement. But if your thesis is like a rush higher, like we started to see in like 2023 maybe, you want people to actually be just putting real money back into the index. So I think we're kind of finding a local top right now. I don't really have a downside target yet, and like I kind of take this day by day. I thought that we would, like in full honesty, my view of the path higher had been, I always underestimate the strength of the return, like the rebound. I should almost apply a factor of like 1.3 to it, because it seems like it always goes a little farther than I expect. First I thought 53 half to 54 half, and then we got there a little bit. We got there too fast. And then I saw some positions in OTC and flex markets where I thought, okay, 55 to 5600 makes a lot of sense, balancing act. And you can see, if you look at the chart pattern before this big gap up spurred on by Trump's weekend headlines, we had a lot of difficulty escaping that range, right? Because a lot of the stuff that was there in the background might have not been visible on the profiles we look at with the public inventory. But the positions that were there in the background were kind of driving this charm down and vol balancing act back down to the 5500s and maybe low 56s. Every time we got towards 5700, you could just feel the pressure. It wasn't stable. And then eventually we got the gap through. When we wound up on the other side of 57.5, very different mechanics, right? All of a sudden you start to see other positions come into frame that are kind of the type of positions that would drive us higher as vol goes lower, especially the JP Morgan collar, the call structure part of that. And so all these things kind of draw us into this range, whether or not there's any real meaning for it, right? This is not like a fundamental measure of evaluation or a fair appraisal of the macro outlook, or even a real fair appraisal of the investability of the US compared to its peers. It's just mechanics. So I think we're kind of going to stall here. And I could be wrong. We could gap higher, but gapping higher would require something to go really right. And I feel like we've already pulled forward all the news.
Gamma exposure, which is Tim. Any ideas on liquidity? Does the low vol environment improving this, like from vol mandate market participants? I'm going to see if I can bring Tim up.
Yeah, bring him up if you can make him talk. No pressure, obviously. But no question is a dumb question, just to be sure. Like,
anybody has a question, raise your hand. I'm trying to get to people and anybody who requested. I don't see anyone who requested. I'm looking for Tim.
It's Tim. Trying to find. It sounds so funny.
Timmy, I know you're here.
Here we go. I'm going to read some of the questions because Charlie had a good question. He's up here, but he probably doesn't want to talk. I invited him to talk, but he won't do it. We talking about this, Tim?
I can't find him on. Crumb Collector has one. That's that one. That Tim.
Yeah,
yes.
Come on.
Tim, come on up, Tim. Crumb Collector, you can come up too. I'm trying to approve you, but there it goes.
It's funny.
Can you hear me?
Yeah. We can hear you, Crumb.
You guys are fantastic, so thanks for doing these.
Awesome.
It's mostly me, not him. I give him all his information.
Yeah, he's reading your prompts.
I'll take what I'm ready to get. How do you guys think about, all right, so obviously I'm a consumer, and I'm looking at options pricing, and it's always hard for me to figure out what's a good buy, right? How does market makers think about options pricing and how they come up with those numbers?
So how we come up with the numbers is pretty sensitive to what happens to our inventory. At least that's my perspective. I know there might be firms that do this differently, but for the most part, you can see this play out in real time, right? Like the last of weeks, I have been increasingly pointing to, in my morning meetings, talking about how, like, look at the straddle prices come down, even though, for example, the 0-day straddle prices come down, even though the ranges, intraday volatility was kind of blowing out, and we were having gap moves and serious reversions at the end of the day, like really heavy flows. But the straddle prices were coming down and down and down. Now, the interesting thing about the way we do things on the market making side, and again, I can only speak in generality, some firms might have more creative approaches and more discretionary approaches, but when you're kind of running a book, just like a store manager, you're going to be sensitive to inventory and flow. And so when something is trending one way or the other, you can't really necessarily justify carrying it or wearing it unless you can actually monetize it. And most market makers, especially recently, I say recently, like in the last 5 years, where there's kind of this tendency towards speed and inventory management and carrying no risk, You're just trying to respond to whatever is happening in the market. So you don't really you try not to take a view, I guess what I'm trying to say here, and you price sensitive to what happens. And then if you look at the vol surface, what you wind up is like, I kind of point to this analogy of like a bed sheet, and not to avoid any kind of like dirty connotations, but if you think about either a buy or a sell happening on this sheet, that pressure, that position, is going to put local pressure on the vol surface one way or the other. And it's going to kind of distribute outwards conically and influence everything around it. So there's this pull. You see, if you actually had a really granular vol surface, you see some pretty big distortions sometimes in inventories that are sizable one way or the other. Because market makers would rather not have a view. They'd rather just get out of those positions for the most part. Now, with respect to like then evaluating positions and whether you like them or not, it's usually a combination of whether you think they're performing. And so like for a skew position, for example, if we're looking at it, we'd have some way to evaluate, okay, do we like owning this? Well, what's the cost benefit? And it's usually on a day-by-day basis. We say, okay, well, how is this realizing? For a skew position, hold on one second. For a skew position, that might not be like an immediately near-term gamma position. It's going to move around a little bit, and as it moves around, we're going to have exposure to VANA, or exposure to Vega that changes because of VANA. And what we want to know then is like, how does implied vol behave when that happens, right? Because if we get a position that has us getting longer Vega when we move down, and we're hedged to start, well, how do we make money? Either we overshoot that move and we actually realize on gamma because we just move so much in the direction of our long, or we move down, we get longer Vega, and all of a sudden implied vol goes bid and pays us out in some respect to a greater degree than what we were modeling in our path. So then we like that position. And oftentimes that might be like a combination of trailing metrics, or it might be something like, at least the way I like to look at things has always been like a game of poker. I like to think about who are the different players, what are their constraints, what types of positions do they hold, and when do they have to move. And then if you know that generally, and you also know how like the market making community responds, you can pick positions pretty well sometimes. For example, I would say it was April 2nd, before the sell-off, I kind of evaluated it. It looked to me like there was probably a good chance for a spot down vol up kind of spiky move, just because it seemed like that the positioning favored, if we got a trigger of a certain size, right, I would expect that actual volatility would spike with it. We get squeezed through some maybe VIX gamma, et cetera. So when I looked at what was available, to me, it looked like natural to just buy May small puts. And this is pretty qualitative. It's not like some people may have very quantitative ways to look at it. I'm sure there are. But for me, it's more qualitative. I'm looking at it through the lens of like, okay, I think this is probably going to perform better than is suggested because of what looks like to be a likely vol path if we get the move that I think we'll get. And the way I think about that then is like, what options aren't, because options have different exposures to different things based on where they are on the distribution. A 5 delta put, or a put that will become 5 or 10 delta, is something that's going to be very, very sensitive to spiking vol or declining vol technically. But that's like the vol of vol option. So when somebody buys a VIX call, if you like VIX calls, you kind of like long out of the money SPX puts. If you think that we're gonna have a spot up vol up moment, but you don't want to commit because you also sense that like we're gonna be grinding up and vol won't perform, there's structures you can do there too that capture that kind of sensitivity. So for me, I like to look at what do I think will happen based on the path through the positions, and then what kind of position would pay me off in that regard. Does that make sense, or kind of answer the question?
It does, and gives you some more material to learn about. So thank you.
Awesome. There we go.
Yo,
What's
guys,
up?
what's up? Yeah, the question I wrote in the comments is about liquidity, more positionings, but maybe you have some color to this as well, especially from low volatility mandates, maybe CTAs, something like that, because media basically tells you that bottom was built in retail in the SPX, right? So do they have to chase maybe something like that?
Sorry, what do you mean? Just who have to
chase price, like from CTAs or low volatility mandates, which obviously brings a little bit better liquidity into the market.
So they would be buyers, obviously, but they're pretty ambiguous crowd. I've heard from a number of people that they have discretion. Same thing I've heard about the leverage ETF crowd, right? So there's this fascination with leverage ETF liquidity, and I'm subject to it myself. But it seems like there's these firms and entities and kind of in the domain that don't have as strict of mandates, or I guess in practice mandates, as like an option market making book would. And they're a little harder to pin down. Like, for example, you still had notes coming out last week or like throughout this week, that CTAs were like skewed to buy in every situation. But I can't help but think that CTAs were probably the buyers to a large degree overnight coming into Monday, right? When we had that big gap up, especially the second leg that really forced us vertical. That looks like CTA flow to me, if that makes sense. Vol control is a little bit maybe more steady and more longer time frame, but I mean, you see Miguel at Nomura puts out notes. I don't think GS actually tackles it that often. Tier 1 talks a lot about vol control. They're there, they're in the background. They will be supportive, especially as Realized starts to sustainably keep below these levels. And they'll provide that like next leg a little bit, obviously. And this is kind of that cycle, right? This is what restores the potential energy. Like now it's kind of being exhausted. They exhausted themselves on the way down, kind of like flipping to short or just delevering, and now they're kind of filling back up. And I feel like now we're probably through the chase period, would be my estimation, and we're more likely to be at like the flattening out point. But I could be wrong. There's just not as clear data on these guys.
Yeah. Okay. Yeah. I know some takes you read out there, especially on X. They are pretty bad. I also remember the Goldman Sachs CTA model. They are often more wrong than right, if I remember. But yeah, it's always a question with these markets rebounding in these V-shaped recoveries, if they are able to chase it. At least that's always stuff that I ask myself.
Yeah, I mean, it goes fast. They execute, obviously. To Goldman's credit, I think they had the flip at 57.03 or 57.08. I can't remember, for like the medium term or whatever it is for CTAs. And if you look at the chart, that's kind of where we inflected in the overnight. It's interesting. It's hard to say if they're in or out. I would love to find a CTA manager that actually ran like decent size, just to understand how it works from their end, because I've heard all sorts of different things. I've heard they use futures options.
Yeah, very true.
But
very true.
It is what it is.
I mean, they're not working with the same approach like every firm, right? They do stuff differently, but I never had an encounter with someone that can explain it to me like it works like this and that.
Exactly.
So, yeah.
Exactly. Cool. Good question.
Victor had a question about options pricing and IV. If you want to touch on that, I invited him up, but he's not able to, I guess.
I don't know the question though.
Give me 1 second and I'll read it here. I got to get to the most recent. How can we determine we are not overpaying for an option position? Seems when IB is high, there is little chance to get good pricing, and futures seem the best value or only value.
No, that's a great question. I think heuristically, I kind of, you can look back sometimes, and it's funny, you look back at prices that you were kind of like choking on the idea of paying, and then you'll see that they actually paid off royally. But there's this kind of like joke about option pricing where when IV is high, you want to buy it, and when it's low, you want to sell it. It's kind of true, because the same things I talked about in VolSignals. The idea of like the market driving the action through the hedging process. But from our perspective, I totally agree. And I think that what I tend to do when IV is quote unquote high, or when things are a bit expensive, is just turn towards spreads and flies, especially if you have any kind of directional implication. And if you have a directional implication that also coincides with an action or like a vol behavior, you can actually like blend these things in ways that pays you off even better. And so, for example, what I mean by that is like if you have a target in mind, and you have a high degree of confidence in that when you get to the middle of the target, there's going to be either a vol drop or the move will be slow enough to kind of land there. You always want to be buying options that you go through and selling options that you land on, right? Or you want a position that will get you shorter. You want a position that will get you exposed to vol in a way that your position makes money when vol drops. So that's the short Vega position, obviously, but you can do this in a number of ways. Usually it's like some combination of ratios, spreads, or flies. When vol is low or IV is low, and we're actually kind of moving, and you're not concerned about the premiums you're paying, I always recommend just opening single legs, if anything, and not like cutting off your convexity. Because oftentimes, sometimes you look and we're so used to pricing spreads if there's our tool of choice that we forget to sometimes check the leg prices and realize what we're doing, right? A good example of this, there's a potential iron condor fund out there that I won't just even like name or guess who it is, but they were selling some size recently in 5-point iron condors in the 0-day options. Now, if you know how option prices work, or like familiar a little bit, you can't just choose symmetrical structures and assume that the pricing will be remotely similar. When you look like symmetrical distance around the money, the put premium will be so much higher than the call premium, especially when you go out to the wings. You'll get to a point on the wings where like the calls are like 15-cent calls, and the same distance away, the puts are like still dollar puts. And funny enough, there's an iron condor that traded where the customer sold the iron condor. I mean, they sold both of the inside strikes to buy the outside strikes. And the call spread, actually, if you broke down the legs, they paid premium to sell the call spread. So they paid brokerage and they paid premium to sell the call spread. So I just encourage you guys to take into consideration leg prices. Don't price yourself out of, for one, I wouldn't recommend selling 10-cent iron condors to anybody. But in general, just when vol gets low, don't sell what you don't need to, if that makes sense.
I think it makes perfect sense. Does anybody have any questions for our rock star here, or?
There was a good question about positional hedging. Let me see. It was Charlie's question. I invited him to talk, but he's maybe a little bit shy. Said a bit of basics. Customer opens position. There's the initial hedge. Spot changes, IV changes, and time passes. That's dynamic hedging. And he says customer closes the position before expiration. What happens? So as a market maker, you're just closing the hedge, right? If a customer opens a position, we hedge that at the time of trade. The impact is usually just tossed into a book. It's internalized or it's netted against stuff. These things we can't predict. It might as well be futures trading that we can't predict. The event lives globally in our position, and its delta is going to evolve. And as it does with every other options delta in our book, you see us hedging dynamically the net of this whole thing, the aggregation of all this stuff. But at the end of it, when you're going to pull this option out, when a customer closes their position, it's the same thing in reverse, right? It doesn't matter, like from a technical perspective, from the lens of like the market as a whole. It doesn't matter if the option was open already or whether it's a brand new trade. When they trade an option, it's going to be hedged on its delta at the time of trade, if that makes sense. And then the customer, of course, can just hold it through expiration. If they hold it through expiration, what that will mean for most products that aren't cash settled is you'll just get replaced with the stock at the end and your hedge will kind of net out. But for SPX cash settled, you wind up having a lot of delta management to do. You'll hedge that option either to 0 or 100 delta. And then if you're hedging it to 100 delta, you'll want to roll your delta out. That's often done, like I mentioned earlier on the call, with the taco contract, or you do it with actual rolls. Rolls are less commonly traded, I think, than they used to be, especially because people just wind up having an easier time taking delta into settlements, given all the products out there now to do so. But a roll is just like literally it's a synthetic in one versus a synthetic in another. And by synthetic, I mean a combo trade. So let's say, for example, I, as a market maker, sold the May $57 calls, and the customer decided just to never come back and take their money. You're gonna let them go to expiration. So I sell these and I buy futures. Let's say I sold these way below. I was kind of like, let's say 56.5. Sold them. We rally through them. As we rally through them, I'm buying more delta. And then even if we keep rallying, even if time just passes, I have to keep buying delta. That's because of charm. And all of a sudden, at some point, they're basically 0 delta or 100 delta calls. These are calls, so they're fully hedged. They have no more dynamic influence on my delta hedging process, but they do exist in my book paired off against 200 ES minis that I'm long for every 100 calls that I'm short. And so now when we move into, and these are June minis, obviously. So now I have something called the delta swap on. I'm short May cash delta, which is this morning's print. I'm long June futures against it. And so I'm concerned now that there's going to be maybe some variation in this. I want to close this delta swap. So for me, as a market maker, I would go to the pit, the floor, quote somebody on something like, I want the May-June $59 roll. What they would literally give me is a quote on, or a price on a structure that looks like this. It's the May 5900 call long versus the May $59 put short. And then against that, it's the June $59 call versus the June $59 put. The traditional way of quoting it would be the June call over. So it's long June call, short June put, short May call, long May put. And for me, I want to sell this structure. And if I sell this structure, I create a neat little feedback loop where I get rid of all my risk, right? I now move my delta exposure back to the May expiring contract, which means there's no basis anymore. And I close my position in June. And so now in May, I just have a box on, meaning I'm like long the deep in the money call, but I'm short near the money call against it. And that near the money call is also paired off with a put. There's still optionality because I haven't paired off the bottom strike with put yet, but the gist is the same. The delta exposure is done. That's the gist of what happens all the time. You don't usually wind up holding your delta and like closing it with the settlement. Most of the time it's moved around with these different trades like rolls and against other data flow too. So hopefully that answers the question, but I don't believe he's here anymore to hear it.
We have several questions. I'm going to go back to like one we skipped. Which measure of SKU is better and why? 25 put, 25 call, or 25 put, 25 call, 50 call kind of vibe? That was from Lauren.
This is awesome. Great question. There's actually, so next week there's a guy joining the mentorship to administer, and he comes from the banking side. It's super exciting because he's managed some of the biggest positions out there, and he's going to come and kind of do the same thing that I'm doing at VolSignals. The whole idea was like get people that have done it, behind the scenes and kind of give our insight. So he's going to have, I know he has so many ways to look at SKU. I hope he's listening. I won't give away any of the secrets or whatever, but the gist is that when you compare 25 versus 25 or 20 versus 20, whatever, you're trying to ascertain something about pressure on the peak Vanna points, because that's related to what you should expect with spot vol correlation. Like, we go up or down, how does vol perform? How much pressure is there on hedging in this complex? The reason you divide it by the at the money is just normalism. So it's not like one is totally better than the other, but I'm guessing, if you were to do a look back, there's probably studies out there. It's better to normalize it, is my guess. I would steer clear of naive measures. SKU is actually my favorite to steer clear from, or at least just look at the breakdown, read the white papers and make sure you understand what they're actually. The reason I like 20 versus 20 or 25 versus 25 divided by the at the money is because it's simple enough and it's clean enough. It gives me a quick heuristic. Like, okay, look at the most Vanna sensitive put and look at the most Vanna sensitive call. If I'm most of the industry's hedging kind of neatly consolidates in those points for good reason, that gives me a quick rundown of like where the pressure is on the index. If that measure is high, then I'm going to understand something about the tension in the index. If it's low, there's something else going on. What I would caution against is there's a lot of systematic stuff out there that just builds positions like we see right now. We're on top of one, literally at the moment. And that doesn't mean that there's some change in behavior, but it does force SKU to move regardless as spot prices move around it. So, for example, if I'm a market maker and my only position is long enough call, I'm going to be SKU, or short risk versus my book, and all I'll be doing is marking down SKU. So this metric, this 20 delta put versus 20 delta call divided by at the money, will seem pretty high, as that's my only position. Now, as we go towards that call, so we keep rallying to it and through it, I no longer have the same exposure that I used to, right? Once I'm on the straddle, I don't have anything but Vega. There's no more Vanna in my position. There's no reason to have a SKU surface that tells the market anything or tries to get into a position for any reason. So at that point, if I were just making markets on inventory, my SKU is flat. If I keep going, all of a sudden I actually have downside exposure to Vega. That would be a short Vanna position, again, meaning that there's just a negative sign with your correlation. If I go up, I lose Vega because I'm moving away from my option position. It goes from like a 50 delta to a 20 delta. By the time it's a 20 delta, it's gonna have maybe 60% of the Vega it has as a 50 delta. And now I actually have a Vanna position the other way, right? So it's the same trade I made in the first place, the same exact call option, the exact same strike and the exact same tenor. But because spot moved through it, my SKU should completely change. And that's something that I don't think people understand. This is very mechanical. It's so mechanical, sometimes it's programmed into path, and everybody does some version of it. And so when you're looking at these metrics, just make sure you understand what they're tracking. The reason I brought up SKU earlier, the CBOE's index SKU, is because they actually track 1 month out 2 and 3 standard deviation puts. And so that's pretty far off the surface. But neatly, every single time lately, when we're coming up and pinning a JP Morgan collar put spread collar call, usually what's going to happen at that point is if we're close enough 1 month out, that is going to move into frame. And that's going to start driving the CBOE SKU index calculation up and up and up, because market makers don't get that inventory back. There's no one that comes and sells it. Most of the industry winds up trying to cover that hole themselves. And so that gets distorted in the implied vols, and that forces that kind of SKU measure up. It doesn't actually tell you anything about what people are doing going forward, but it does just capture this little distortion on the vol surface. So you have to know what you're looking at when you're looking at these metrics.
So I have another question from someone we know, and the question I'm going to paraphrase is, how do you go from being me to being more like you? How do you take an intermediate personality that has the intellectual horsepower, I guess, to get them to at least the basic level of understanding that you can speak on clearly and freely?
Well, you just don't stop learning, right? That's why I started this, because I love this concept. I love the conversation. I love the
topic. Is there a mechanical process? I mean, you obviously have VolSignals. You offer, you offer something that helps people get there, is what I'm trying to say.
I would say don't benchmark yourself to me, because this is it would be like me asking one of you guys who've done a career for just how do I get to know exactly what you do every day with the same level of intuition? You can't do that. If I could teach that in 3 months, one of us should be a billionaire. But the reality is, when I started at my firm, I was tasked with making the training program. So I got to like the stuff. I got to like teaching it. You have to read and stick with it. You also have to go with what works for you. So if you're math first, then focus on the math first. I teach this through an intuitive lens. I try to get people in the mentorship and tell them, look, I will stick with you until you get it, because I was used to, you have to get people to understand what's meaningful about it, in my opinion. I would avoid, whether you're math focused or not, if you're trying to trade, you're trying to distill an influence from this stuff, I would caution against I call it like worshipping at the altar of precision. It's an opaque domain. Everybody models things a little bit differently. You're never going to have a precise anything. When you see these fancy tweets about like we tapped the line and reversed it, it's all just kind of noise and luck. You want to be able to understand the mechanics in a way that can help you make quick, intuitive decisions. So with that in mind, like what I try to teach people is how to understand what's important. It's magnitude, it's direction of the influence, and it's how do the actual entities interact and work, right? And so I think we've done a good thing at in the Discord and in the mentorship. I think that it makes it easy to understand over time. Some people have an easier time than others. But what I love about it is that everybody kind of gets chilly. The books that I kind of advise people to read, we have, the Vol Studies obviously is one with the Natenberg option, volatility, and pricing. That's like the bare bones. Funny enough, like he actually was tasked with running the training program at CTC, Chicago Trading Company. He probably still has alliances with them, but it's a really good book that everybody kind of gets when they join a market making firm. Start there, obviously. And once you feel remotely comfortable with like what the mechanics are, I shouldn't, I'm not trying to sell myself, but I should really. The mentorship is good because you can't find this anywhere else. If you want to know the mechanics and how they work, I think the people in our group and everybody's doing a great job of figuring it out and also applying it in real time.
Okay, so next question. I listen. Everybody listening, he's a rock star. He's a born teacher. He should go and give courses somewhere when he finally does retire, when he turns old.
No, we will. We're gonna have the keys to options.
You're going to go to UM and you're going to help. You're going to go to community college, not UM. You're going to help regular people, bro. We're going to have it on. We're going to have the classes on my boat. Okay, I got that.
No, I love teaching, but I want to keep it fun too.
Hey, listen, we can do fishing and trading at the same time. We got Starlink.
Perfect.
So I'm going to skip that question. I'm going to do this question because I think this is relevant to everybody who's listening who is not a Jedi like you. And I'm quoting, the recent rally has seen retail names like PTLR, Hood, etc., and the MTUM ETF perform very well. Is there any indication from the options market that a potential unwind of the momentum factor could be larger if the index is stalled? Well, if the name stalled, then index is stalled. I don't know, understand that kind of. Maybe you do.
That's a good question. That's more cross complex than kind of under the hood, I think, than I'm just even opining on. I would say. Of course, I think that it could be a big problem if momentum factor stalls. It kind of had trouble coming back in the first place, and now I think it's over relied on. I don't have a great answer for that, except I kind of am in alignment with the idea that it could be problematic. But we'll see what happens. I look more strictly at the positioning in the index. But there's probably a lot of value there. But if you'll notice, like it's hard to be so in the weeds with every single thing. So.
Okay, I want to do Hugo because I like his question, but I got to do this one first. Oh, no, Hugo is next. No, Vanis. For risk management, what techniques do you use as best practice? Are you using Kelly criteria? Do you target a win rate or an RR? I know it's personal preference for a lot, but curious on your thoughts.
Yeah, I target kind of a win rate effectively, and then I try to take my premium off the table. Usually when I have a view, like I have like a longer term account and a trading account, but I'll try to keep my view as like, my view being like either it's a medium term trade or it's a short term trade for a 0 day. I'm going to have an idea of like how much percentage of my account I can attribute to that view. And then I will scale or allow myself to scale into a portion of that trade. Whereas like maybe I'll start out with, 25% allocation or 30%, and then give myself enough rope, I guess, for lack of a better term, not a great connotation there, but to actually kind of double down if I still think that the view is good and it's moved against me. But then I have to be strict to cut myself off, because if you guys heard my Spaces call before, I'm very prone to becoming certain. Very easy to become like lulled into the sense of false security and just overbet. And so I am kind of at this place in life now where I'm okay with the fact that I don't over. And the flip side of that is I probably don't press the pedal enough sometimes, because I'll take premium off right away. And so sometimes this burns you, but I've not been disappointed with it. I think almost every single day you can find a situation intraday where there's a trade that's likely to at least double up. And if you can find that and just take your premium off the table once it's doubled up and then work yourself into something that still has the edge in it, you're going to at least, it's like contact baseball. You're going to produce a lot of little hits and runs over time and not really worry about, not go to sleep worrying about the balance. That's just the way I've kind of evolved into doing it. I'm very prone to, I shouldn't say a gambler's mindset, but like it's exciting to bet big on a view that you have conviction in. But I have to always discount myself and I always try to pull my outlay off the table as soon as possible.
What I heard you say is good risk management means you know, if you're a winner, get your money out and then gamble with house money.
Yeah, kind of. But I know it kind of goes against a very smart way of doing things too, where people are like, you're supposed to cut your losses early and let your winners run. Well, I kind of just, this maybe goes
But
back to that whole point about
if
like,
you take
what's
your
your,
principal out, you have no risk. I mean, you've got your money back out. So anyway, next question. How do large institutional orders like delta neutral hedging or vol harvesting influence your book? And how do you spot them in real time? Would it be possible for a retail trader to see this during trading hours? I know the answer to that one, but I'm not going to say.
I would say the answer is yes and no. It's very hard. Like today, we're going to have, for example, the QIL or the XYLD that's going to execute. Some of these are actually like on
Well,
prospectus.
I think he meant it from the perspective of as a market maker, because we don't have the same screens that market makers have, is what I got out of that question.
Again, that's why I love doing the mentorship, because it's been able to bring people an insight that you just don't get anywhere else. Like there was a time in which I had a spreadsheet with over 1 million contracts and trades on it. And at that time, I was obviously market making, but I was following customer flow. There were books that had, between them, like these certain funds had over 1 million contracts in play themselves. And being able to track that and follow it and know the constraints is super valuable sometimes. It's not easy when you're not actually handling the flow, like you're not a broker or a trader yourself. But there are some ways to do it. The options that platform gives you flow tools. You can look through different time slices and find systematic timings or strike regions and stuff. That gives you some insight into if somebody's doing something all the time. We'll find them and track them. But really, you just want to track them and know how to behave conditionally around them, right? So I talk about 2018 all the time. I'll do a spaces on 2018. Again, because that was a really influential time in my career also to understand how significant it is to watch these counterparties. There's no good answer, like cheddar flow, unusual whales that try, and they are oftentimes, not to dig anybody, but incorrect because of the way these things are calculated, or sorry, the way they're actually reported. And even when they're in single name products, for example, if you look at these big overwrites, even those are marked wrong sometimes. Jane Street might quote NVIDIA options 1 to 110 all day, but then a big overwrite comes in to sell vol and size, and they'll pay 109 on it, and that gets spread through or sent through like it's a sale when it's a buy. And there's no good way to figure that out from the outside. But I'm going to cut off here and switch to the Discord because it's actually 9 o'clock already. But good chat. And we'll do the morning meeting in the Discord. Cool.
You have more questions in here. I don't know. You want me to post them and you can get to them later or no?
Yeah, good idea.
Okay. All right, man. I'll see you in a minute. Bye.
Good luck.